Ready? Okay. So, and so as I said, there are 50 questions, 120 minutes, but the questions are. One person says I can't hear anything. What about the others?
Yeah, we can hear.
Me?
I think I can hear.
Okay, right. Thank you. Right. Okay. So we have, as I said, there are 50 questions, but it does not mean that you are going to spend 4 minutes each question. Certain questions you will spend 1 minute, certain questions you will spend 5 minutes, which you will do with your experience. After 10 lessons, as Anju said, I will be doing 9, and Anju will do 1. So these are the way that we have structured. First day, this is what we are going to do. Second day, third day, fourth day, fifth day. We can see. One day, I have put up a question session. So on the final day, I mean, these are the only questions we will be doing. Tonight, I will be sending you a lot of questions after this class for you all to do it, and will give my email. You will me the answers. I will come back to you individually and give you all the feedback, and even in the class we can always have it. That's basically what we will be doing it in these classes as far as said. Today we want to start a couple of areas, and we will look at areas what we are going to look at. As I said, I will be moving. Time you can stop me. Any questions? You can put a message on the chat box. You can put up your mic and speak to me. Whatever not clear, you just have to shout, and then I will hear it for you. So, first lesson what we are going to look at is what we call accounting concepts and principles. Concepts and principles. This is our first lesson. Hello. Yeah. Keep your mics mute. If mics mute, if you want to ask any questions only, put the mic on, because that will make the class very clear for everyone. Going to move in to the concepts and principles. At the end of the day, you accountants, as financial accountants, we prepare financial information. That financial information, we it's a name given for this financial information. We bundle all this financial information. We
कोई पेन और पेपर हो ना मेरी ऑनलाइन क्लास चालू भी हो गई
something called financial statements.
10:15 का टाइम
Mike's mute. That will make the things very clear for all the people. Mike's mute. Okay. So all what we do is accountants, we gather a lot of information, financial information, we record it in certain records, and then at the end of the day, and that is what our ultimate purpose of everything. So, what are we preparing this financial statement? Why are we preparing financial statements? Financial statements are prepared to information whom we call stakeholders. Who are the stakeholders? Stakeholders are the people who have an interest in the business. So, if you and I are running a business, who are the people who will be interested in our business? Surely, owners are interested in business. Are interested centerpieces. Because it is their money, they want to know whether they are running it at a profit or whether they are running it at a loss. So we provide financial information in form of financial statements to the owner. There are certain lenders who have given us money. We will be interested in our financial statements. A bank who has given us a loan for our business will be looking all the time to see how are we doing it. Employees. The employees will be very, very focused to see how are we doing it. If you have a lot of employees, they want to know whether they will get their salary on time and all that kind of a thing. So they will be looking financial statements. So the government wants to tax us if we make a profit. Many people who looks at this financial information prepared in form of financial statement. So the people, whoever who are going to read this financial statement, should be able to rely on this financial statement. They must be able to rely on the financial statement. So for that purpose, the financial statement must be prepared in some standard form. Not that everyone can do it in their own way. It must be prepared in some standard form, and for that purpose, the accountants, we as accountants, we are given certain guidelines. We are given certain guidelines how to decide on our revenue, how to decide on our income, how to decide on our expenses. So things are given all the things. Hi, hello. Switch off the camera. The mic's mute. The matter is very clear for you all. Keep the mic's mute and keep the camera shut off. Okay. So basically, what we need is to have some guidelines to prepare the financial statements, because otherwise everyone will prepare it in their own way. It will be very, very difficult for them to make any understanding. Kindly keep the mics mute. Please keep the mics mute. Mics mute. Will help you. We know financial statements, there are so many sets or so many variations we can have it. So because of that, what we need to do is we have to have some standards. Purpose, what is follow when we are preparing the financial statement. If you can, because I have a lot of disturbance, if you can keep your mics mute, it will be super. Keep all your mics mute, it will make the class much more clearer. Thanks a lot. We are going to look at these accounting concepts today. We can prepare financial statements in many ways. There are many things what we can do, and we will have the financial statements. But we want to look at these financial statements and see how we can do it together. So, we are going to look at, there are 8 main financial concepts what we need to learn whenever we prepare financial statements. This is the guideline that is given for us. And these are called conventions. It's called the accounting conventions, and
हाँ ऑडियो में जाके कॉल फ्रॉम कंप्यूटर ऑडियो में जाके कॉल फ्रॉम कंप्यूटर करो। नहीं नहीं ऊपर ही कुछ आ रहा होगा ना कि मलयाली पढ़ा रहा है शायद।
Oh God.
और ऑडियो में
This
जाओ
is
और कॉल फ्रॉम कंप्यूटर हाँ यूजिंग कंप्यूटर फॉर ऑडियो।
you use the computer audio to be connected.
अरे कोई बत्ती की हंसने की भी आवाज आ रही है उसको समझ में नहीं
Get the computer audio get connected with the computer audio. Today is somewhat in detail these 8 accounting concepts or what we call accounting convention. Whenever we prepare the financial statement, these 8 concepts always out of there are 3 very important ones: distancing and relating. Important one, but it doesn't mean the others are not important, but all are important. So we need to have these accounting concepts going all the time. One I'm going to look at is the going concern concept. Questions that you all have right at the moment. Any clarification you want to have it at the moment? Silent, I'm going to assume that no questions and I'm going to go forward. So
1 second, Kumar. 1 second.
Sorry.
I just want. 1 second, Kumar. I just want to ask all the participants to mute their mics, please, because there's background noise. So appreciate if you can mute your mics. And if there is any questions that you want to ask, unmute your mic and ask the question at that time and mute it again, please. Appreciate that. Thank you. Thanks, Kumar.
Some people are asking me how to get the sound. You have to go to that link and connect the computer audio. The computer audio. That's the way that you will get your sound. Okay. Yeah, I will go back to the previous slide 12. All these slides, don't worry. I'm sending it to you all. It is in the Dropbox. You can see all these slides. It will be available. The recording of this session will be available, so everyone will have access to all these things. Okay? So there are 8 concepts. So most of the time your examiner will be asking in a short question, in a objective test question, either to name 8. Yeah, Shaista. Shaista, anything you want to know? Any questions? You put it on the chat box. I can see it immediately. I can answer any questions. All will be ready, and yes, can get it on the computer sound. Anything on the chat, we will get it immediately. These are the 8 concepts. We are going to look at one by one this concept. One concept. Whenever we prepare financial statements, whenever we prepare accounts for a company or for a business, we believe that the company will continue operations for a foreseeable future. Foreseeable future is defined to be at least 6 months ahead. Whenever we prepare accounts, the assumption is will continue. It is not going for liquidation. It is not going for a draft activity, at least for next 6 months. The number one concept. So that this is called assumption. You assume that whenever we read the financial statement, that business will live for at least next 6 months, and that is what we will be looking all the time. So there will be no drastic cutback or anything. If at all, if there is any drastic cutback or anything, You must state so. You must it out and fill them. The next one is all considered assumption, no longer assumption. It is called approval. You know, business, we do business, we receive money. If we will get $1,000 and we have to pay. We have to pay our pay the goods, we have to pay purchaser 6,000, our salary 2,000. So during a period, because the financial statements are prepared always for a period, and for a 12 months or 3 months or 6 months or something like that. Maybe you have sold goods, maybe you have not paid for the goods yet. That is big. So always we don't purely go by cash and cash out, go by income. Please headphones and also please go to the computer sound. You should be able to hear it. So the approval basically don't go by the receipt and payment to incurred and earned. Earned and expenditure incurred. So maybe you are not paid for expenses. Maybe you are not paid your salary, but you will bring those as accrued expenditure. Yes, please mute the mic. Still, there is lots of background noise. Kindly mute your mic. If all of you can mute the mic, it becomes much more clearer. Some people are still having background voices in all the class. Basically, we need to, yeah. So please mute your mic and please ensure that everyone has mic. Okay. So, approval's concept is basically we don't go by purely on the basis of the receipts and payments. Whenever the financial statement, look at income earned, whether we have received the money or not, expenditure incurred, whether we have paid or not. And that is what we call approval's concept. So earlier, both these concepts were concerned were recognized as assumption. Assumption. In other words, whenever we account, it's assumed that this is done. Now, not so. The main concern in the assumptions, approvals is no longer assumption. The third one is what we call the prudence concept. Prudence means accountants are supposed to be very conservative. They are not going to take credit for unrealized income. We are not going to ignore any liabilities. We want to keep our financial statements on a very conservative basis. So, for that purpose, the transaction will be recorded only whenever there is certainty. So whenever there is uncertainty, we need to take what caution. We don't just do it, we take it all the time based on prudence. So that's another very important concept you will learn today. You will practice till you end your career. Because this is a concept we will use it all the time. The next one is what we call consistency. Whenever we prepare financial statements, there has to be consistency. What do you mean by that one? Whatever the treatment you do will be followed year by year, period by period. So you are not going to prepare financial statements in tomorrow in another way. There are certain standards given to us. With the standard, even our own judgment, we will use the same judgment. We will learn something called depreciation. So, depreciation is something called annual wear and tear of the use of the asset. So, if we think it is going to be 20%, it should be 20% next year also. We should not change the figures on and off. It should be very consistent. Whatever we do should be made consistent because one simple reason it should be able to compare. Financial statements are a tool for comparison. We want to see compared to last year how well we have done. So last year we have made a profit of 20,000. This year we have made a profit of 30,000. If you have prepared the financial statements on the same basis, we can definitely say we have improved our profit. But if we don't prepare our financial statements on the same basis, then we can't tell that our profits have improved. So the consistency is maintained for comparability. I think yesterday or day before yesterday in the objective test questions, this was one of the questions the examiner put it up. Why the consistency? Consistency is for comparability. To compare your company's performance last year to this year. To compare your company's performance with another comparable company. How is your competitor doing? How much profit is he making? How much profit we are making? Compare with our budget. We prepare a budget and we want to see so the budget and the financial statements both must be on the same basis. That's what we call the consistency. So one period to another must be treated in the same way, and that's what we call consistency. And that will only make the comparisons valid from one period to the next. So always we must the statements in that way, and that is what. So we have done 4 concepts. 1, 2, 3, 4. There are 4 concepts. Number 1 is the going concern. Number 2 is the accruals. Number 3 is the prudence. Number 4 is the consistency. So, as I said, there are 8 concepts which you are going to learn. The next one, the next 4 is what we call the materiality. Materiality means we want to see whether because when we prepare the financial statements, we have something called big transactions, small transactions. Now, if you are a business that is dealing with 100,000 revenue, a $1 mistake of into the wrong account, $5 into the wrong account will not make that much of a difference in your profit and loss. If you are a company that is doing only $20 business, this $1 will be very, very big. So it all depends. It's a very subjective one. Finally, we have to see whenever we prepare financial statements, whether those mistakes, whether those misstatements will cause decisions the user to be changed somewhat. So that's what we call the material. In other words, it must be figures should be always right. Little, small things, but what is big will be very subjective. For a small trader who is doing $100 business, even a $2 will be big. But for a big trader who is doing $1 million business, $2 wrong accounting, right accounting will not make too much of a difference. So whether that mistake or misstatement or the omission will it make an influence on the decision maker. That is what we call the materiality. So whenever we prepare the financial statements, at the end of the preparation, the auditors will do, there's a people called set of auditors, they will look at this account and tell us, yeah, this figure is not right. And as the company owners, the company directors, you may have to decide whether we should correct it, rectify it, or whether let it go. small amount, let it go. Because the user who is going to use will not get influenced by that $20 erroneous entry. If it is a $500,000 erroneous entry, wow, that's not good. Immediately you need to correct it. So that's the meaning or the concept that we look at all the time, what we call materiality. Next one. Next one, it's all about the substance. It's a substance over form. So whenever we do a transaction, we have something called legal form of the transaction. The transaction has something called a legal form. The legal form of the transaction is simply the legality. But as accountants, we go beyond that one and we try to look at the substance of the transaction. The slides will be available. All the slides will be available for all of you all in the Dropbox. And anyone who wants the slides, if you don't get it, send me an email. My email is simakuma55@gmail.com, and you can send me an email, and I will send you the slides. @gmail. You can get, you send me a mail, and I will send you all the slides. If you can't get it on the this thing, send me an email, and I will send you all these slides will be available for all of you all. Don't worry, it is available for everyone. Yeah. Right. Yeah. So, yeah. So basically, some people are not hearing it very clearly, but maybe my internet is not very good, but we will try to correct it. So, the substance is basically the principle of the transaction. Now, for example, one good example what I want to give is you lease a vehicle. Sometimes when you lease a vehicle because you don't have money, you don't have bank loan facilities, so you go to leasing company and buy a vehicle. And legal ownership is with the leasing company. If you pay the lease rent, they will not transfer you the ownership. So the legal ownership is with the leasing company. The you are the user. You have full control of the vehicle. You can do anything with the vehicle, whatever you want, because you are the user. So what we recognize is the control. So long as you are controlling, it will come in your own statement of financial position as an asset, even though the legal ownership is not with you. So whenever we talk about asset, it need not be that we have to have a legal ownership. What we look at is all the time trying to see whether we can uh, get the substance of the transaction. We have to go beyond the legal form and see whether we can get the substance of the transaction. That is what we call the substance over form. Just give me a minute. Okay, so then the next one is another very important one, what we call the entity concept. Business, you are the owner of the business, but for all purposes, you are a separate person and the business is separate. So you may be the owner, but business is totally, it's you will earn a profit for the business. If you take anything out of this one, it will be considered drawing. That's a thing. Always the business is considered a separate entity concept. Don't mix up your personal money with the business money. Don't mix up your personal income with the business income. So you have to regard the business as a totally separate. So most of the people don't understand it. I worked in a private place, and he was the owner. He was the sole owner. It was his money, but sometimes he comes and takes items from the shop without informing anyone. But that is not right, because even though he is the owner, business is separate. So whenever he takes something from the business, he must pay for those. That is what we have to look at. So not all the time the business will be all the time. You have to consider the entity concept. Business is totally separated from the owner. It can be a limited liability company. It can be a individual company. You have to make it. Vishnu, anything you want to ask? Okay. Have any questions? Please ask me. Otherwise, I'm just going on. Okay. The final one is what we call the money measurement.
Just to mute the mic, and he's asking a question.
Sorry, yeah. Yeah, sorry, Vishnu, yeah. Can you ask it again? Hello, Vishnu. Yeah, can you please ask your question again? I didn't hear it.
I didn't ask you a question. Sorry.
Okay, sorry, right. Okay. So, I was talking about the final assumption, the concept, the money measurement concept. So, whenever we deal with the financial statements, we only put up in financial statements what can be measured in monetary terms. It can be dollar, it can be sterling, it can be euros, it can be rupees, it can be anything, but anything that can be measured in terms of monetary terms only will come up in the financial statement. So good, bad, ugly will not come up in financial statement. Only things you can measure up in financial terms. So revenue, sales can measure up in financial terms. Salaries we pay to our employees, we can measure up in financial measurement, monetary terms. But we can't tell whether John is good or whether Pete is good. We can't put it up in the financial statement. That will not come up. So everything that can be measured in money terms only will come up in financial. These are the 8 concepts what we learned just now. Going concern, approvals, prudence, consistency, and the next 4, materiality, substance over form, entity concept, and money measurement. Very famous examiner's question in these areas. Most of the time, he will put up these questions, and you should be able to answer these ones. Now, there are a lot of accounting standards. You don't need to know all the details of accounting standards in the fundamental financial principles, but one of the things that what we need to know is IAS 1, International Accounting Standard 1. That is what gives us the preparation of financial statements. IAS 1 is all to do with the preparation of financial statements. So, as I said, we discussed 8 concepts, but the 3 are extremely important. Prudence, substance over form, and materiality. So, prudence is being very conservative. Don't recognize anything that is not certain. So, you must not try to take any income that is not certain. Right? That is one. Then you must always provide for every known liability, because that's what we call the prudency. Accountants are supposed to be very conservative people. We need to prepare the statements So at the end of the day, when we say profit is 100,000, should not get down to 80,000, because we have prepared the financial statements taking the worst scenario in a way. That is what we call prudence concept. So being very realistic. Don't try to be too unrealistic. Don't try to be too optimistic. That's not the prudence. Substance over form, we don't look at purely the accounting part of it, but we look at beyond that one. We look at purely not the legal part of it, but we look at beyond that one to see what is hidden, what is inside, what is the story behind it whenever we prepare the finances. Materiality. At the end of the day, very important that we have the statements, big ones being properly accounted for. Ignore the small ones. When I say ignore, not totally ignore, but don't worry too much about little things, but material things. Ensure that you have provided, you have done the right treatment. Because if you do a wrong treatment for a big amount, your financial statements will be misleading. People will take wrong decisions based on your financial statements, and you may be called for trouble. Always, your accounting policies must be somewhat consistent with the qualitative characteristics of financial statements. So whenever we prepare our accounting policies, it must have that consistency with the qualitative characteristics of your financial statement. So we will be learning about these qualitative characteristics in a bit, in a moment, but we need to know what this basically it means for us. So the qualitative characteristics are very important. Whenever we prepare the financial statement, we need to be very focused. And the accounting policies are basically the the broad policies that we have agreed upon. They are totally different from an accounting estimate. Accounting estimates are something which arise due to uncertainty. Now, for example, if you look at the assets, right? Maybe you have bought a plant for $10,000, and you estimate the life period to be 5 years. So in that case, 10,000 divided by 5 years, every year you will provide depreciation accounting estimate of 2,000 every year. That is accounting estimate. But right,
Hello?
yeah. But otherwise, you have to deal with the we'll deal with the
Yeah, you can switch off the just press the close button of there and above.
pardon? Yeah, right. Okay. So estimates arise
Huh?
due to uncertainties in the businesses.
Mute. Wait, you can wait. You need to. You won't hear the sound, no? Is that what he's saying?
Hello.
Mute the mic. Go to audio. Go to settings. Then mute the mic.
Yeah. Mute the mic. Mute the mic. You may be able to hear better. Yeah. So if there's a change in accounting estimate, then what you have to do is it should be written off to the same income and expenditure that the original estimate was provided for. So that's another very important thing what we are going to learn it today. Will you give me a second? I'm trying to connect it to the internet directly, whether it will give you a better reception. hello, 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 hello. Hello, hello, hello. Okay. Hi. Uh, yeah. So basically, the change in accounting estimate is something that can happen. So it can happen due to uncertainty. So here again, most of the time the examiner will ask the uncertainty and the accounting estimate that's part of it. So I told you about the qualitative characteristics of financial statements. So there are a couple of qualitative characteristics we need to adhere whenever we are making financial statements. The financial statements we prepare to make it useful to give some information to the decision makers, and that one there are six qualitative characteristics. Two are considered very fundamental. All the time, you need to work on those qualitative characteristics all the time, and that's what we call the two fundamental qualitative characteristics. So there are two characteristics which are very, very fundamental. Number one is the relevance. Relevant. Whatever the information that we give should be relevant to the people. So, in other words, don't give irrelevant information, be relevant with the information. And for that purpose, we have been given certain guidelines, certain standards of preparation of financial statements. The reason we need to give very relevant information all the time. So that's the number one fundamental qualitative characteristics. So as I said, there are two types of characteristics. The fundamental ones, no compromise. We need to keep up with the fundamental characteristics all the time, and that means the relevance is a very, very important one. Second one is all about faithful representation. What is meant by faithful representation is that you will not mislead the people. You will be very honest in whatever the statements, whatever that you are going to give it to them. So that is what we call the two fundamental qualitative characteristics. Number one is the relevance, and this number two is the faithful representation. Then we come, there are four other characteristics. I mean, they are not the important ones, but surely still for all, we need to have those characteristics. Number one, the comparability. That is, you should be able to compare your figures from one year to the other year. You should be able to compare with one company to the other company, and that's what we call the comparability. The next one is verifiability. Your figures, if some person checks it, they should be able to verify with some other independent sources. So later on, we will learn something called ratio analysis, and those things will help us to verify the figures. This is what the auditors do all the time. Whenever they want, they will verify the figures through various ratio analysis and through various other documentation. That is what we call the verifiability. Third one is what we call timeliness. The information should not be too fast, because why we are giving information is people to make economic decisions. So you can't make economic decisions today with the information of 2015. So the information should be very, very close, timely information. In fact, the UK and most of the other countries, they say just after the financial year, 2 months after the financial year, you must provide your financial statement. So that is what we call the timeliness. Basically, all the time the figures must be very up to date and they must be timely information all the time. And it must be prepared in such a way that it is understandable. Now, the people who are reading these financial statements are assumed to have certain basic business knowledge. So you don't need to explain what is a debit and what is a credit and what is asset and what is a liability. The people are supposed to know that kind of a thing, but don't try to make it too complicated. So understandability is that you need the information to be somewhat understandable. So don't put too much of complications, but try to make it very, very clear and make it very simple. But assume, so this was another question I think in yesterday's paper, and they asked, what do you mean by understandability? The assumption is that you will always have the people with business knowledge. They are not the people who will come and ask, hey, what is this asset? No, they know what is asset, but they want to know how you have valued the asset. They want to know what is this, why are you showing 100,000 the asset? They might ask that one, but they might not come and ask you what is asset. That kind of a understandability is very important, and that is what we are supposed to give it to these people. So these are what we call the qualitative characteristics. So as I said, relevant is basically whatever that is going to influence the decision maker. The decision makers are the owners, decision makers are the lenders, decision makers are the employees, decision makers are the government. So whatever the information that is going to influence them, you should give the information. To evaluate the past, to evaluate the present, to evaluate the future, you must give that information. That is a qualitative characteristic fundamental to our preparation of financials. And the materiality, as I said, it's one side, it is the bigness of the figures. Other side, it is the nature of the transaction. Certain transactions may be very small, but it is material for the relevant reader. Maybe, for example, you are a big company in dealing with $1 billion, but due to, say, for violation of environmental aspects, your company has been fined a $50,000 fine. It may not be, it is very small, your company 2 billion business, but the nature of the transaction is such, it is very material. The shareholders must know, the people must know that your company violated certain things and that you all are punished for that one. So that's what we call the materiality of the transaction. So materiality depends not only on the size, but it also depends on the nature of the transaction. Certain transactions by nature is so important to the reader. It may not be very big, but still for all it is very needed, and therefore that kind of information should be provided. Tax areas, for example, right? It may be small amount of tax areas that you are not paid, but that is relevant because the people must know that your company has not paid the taxes. And that is why we have a separate line in the balance sheet in the statement of financial position called tax payable. That's a very important one. Finance charges. You are paying finance charges. You want to know how much finance charges we have paid. So these are very relevant information, and probably that's some information that you want to give it to these people, which is uh, not very big, but still for all it is important for the people to read the accounts, to understand the account. You must always remember why we are giving this information is for the people to make economic decisions. So some items are very relevant because of its nature, others are relevant because of its materiality. So materiality is basically a quality of information, and that must be maintained all the time. So when I come to the materiality, it's a very entity-specific aspects of relevance. Certain areas you may want to work out because your company is a small company, and for you, even a small little thing is very important. So that's what the materiality is all about. So for a big company, it may not be so. Right? It may not be so. So you have to look at all the time and see how it need to be done. So next one is all about the threshold. Is all about need to study before considering the other qualities of that information. We must see whether this information is relevant to be given. And if it is so, why we need to give it. If it is not so, why it is so. So that's what we need to look at all the time. Then cutoff point is basically if it is not material, then we don't need to worry about it. We can forget about it. So if it is not material, you don't need to look at all the time and you can just walk on. Faithful representation, as I said, we CIMA accountants are supposed to be ethical. We are supposed to be full of integrity. So whenever you work in another company, you need to be all the time looking all the time to be faithful in whatever you're doing. So that's a very, very important thing. We need to make it very faithful all the time, information. So it should be presented in substance and economic reality than the legal form. Many people, what they do is they try to use this information um, on a on purely based on legal side of it. But we know lot of people can do things to make the things very misleading by trying to be somewhat all the time by somewhat being legally right. But as accountants, as CIMA people, we are all the time to be ethical, and therefore we need to be full of economic reality. Right. For faithful representation, financial information should possess the following characteristics. So we need to have these characteristics. Number one, whatever the information we are giving, it must be complete information. Never give a kind of part information. You have to give complete information all the time. And your information should be neutral. In other words, it should be free of bias. Most of the time, what happens is we give information which are biased. Maybe because I'm going to get a bonus, I want to prepare my financial statements to show a big profit because I know I'm also going to get a bonus. Or maybe my big boss, the finance director, is telling me, Kumar, you must prepare the financial statements in such a way to show a loss because we don't want to pay taxes. Or maybe another person telling you your financial statement should be prepared in such a way that you show a big profit because we are going to sell the company, so we want to show a big profit before we sell the company. But that's not faithful representation. We have to be neutral. We have to be very objective whenever we prepare the financial statement. And the financial statement should be free from error, free from material error. Information must be free from material error. Little errors are acceptable, but it should not have big material errors. If you have material errors, one thing, the auditors will not certify the financial statement. Other thing, you are not supposed to put out the financial statement with material errors. That is not right. So, what are the qualitative, the enhances? I told you these are the first two, relevance and the materiality. Now we are going to talk about the enhancing qualitative characteristics. Number one, the comparability. As I've been always telling, financial statements should be comparable. Second one, it should be verifiable. Whatever the figure that is reflected in the financial statement, it should be verifiable. You should be able to show the financial statement and tell you what are the things. So verifiable. Any person should be able to ask you a question. You should be able to answer. You can say I don't know and you know something like that. The figure should be verifiable. For example, in the financial statements, you will have end of the year physically verified closing stock. Auditors may want to come and check the closing stock, and they want to directly observe the closing stock. So it should be verifiable. So you can't say yes, yes, it is in books, but it is not there in the warehouse. That's not right. It must be properly verifiable. Timeliness. As I said, all the information should be very timely. Don't give cool, rotten information. It's useless for the investor, it's useless for anyone, and that's useless for everyone. Understandability, as I said, everyone is supposed to, who are reading the financial statements, is supposed to have some business knowledge, a reasonable business knowledge, and we must present it in such a way with reasonable business knowledge that they can understand, and also they are willing to study, and also if they want, they will get a qualified person to read it to them. But it should be something that the people can understand. So all what we learn, our jargon, our everything what we know, we can't put it into the financial statement. We must prepare it in such a way that the people can understand. It's like a doctor. Doctor will know lot of medical terms, but when he talks to the patient, he will have to talk to the patient in the simple language the patient understands. Similarly, whenever we prepare financial statements, we will know a lot of things, but we have to prepare the financial statements in such a way that the people can understand. So one of the big things in the financial statement is to value the items. The sales we need to value, cost of sales we need to value, the property, plant and equipment we need to value, the inventory we need to value, the salaries and wages we pay to the employees we need to value, the we pay we need to value. So there are lots of valuations that what we have to do with. So one way that we value is particularly the asset we can value at the original cost. So we look at the original cost, what they spent. So we bought the asset for 100,000. So that will be the initial valuation for the asset. So that's what we call historical cost. Imagine you buy a vehicle for $10,000, and maybe after 5 years, if you look at that vehicle, it may be worth much more than 10,000, or it may be worth much less than 10,000. So your historical cost, just keeping it at historical cost will not be right. We need to depreciate it. So we need to depreciate this asset every year. So how do we provide depreciation? We look at the value of the asset. We look at the estimated life period of the asset. So maybe the estimated life period is the economic useful life period for you. Not that the car is going to go out of running after 4 years, but for you, this is the economic life period is 4 years. So 10,000 is the value of the car. 4 years is the economic life period for you, because after that it's not economical for you to keep the car. You will sell the vehicle. So 2,500 you will provide every year depreciation. So at the end of first year, 10,000 is the vehicle. You provide 2,500. The value of the vehicle will appear at historical cost minus depreciation 7,500. But if you want to sell this vehicle, you might look at the market value of the vehicle. The market value, or if you want to sell this vehicle, the replacement cost may be much more than 7,500. With inflation, it can even run up to 11,000. So there are different values we can place on our statement of financial position. But we are guided by certain guidelines. One way we can work out is what we call the original cost. Second one, we can look at the historical cost, and maybe after 4 years, 2 years have gone, and it is 5,000. So this is called written down value. This after depreciation, the value is what we call the written down value, or sometimes we call it net book value. Net book value, written down value. So most of the assets will appear in our statement of financial position as net book value. But sometimes we work out not on the historical cost, we work out on replacement cost. We try to see, okay, the vehicle what we bought last year, today, after 1 year, if I want to replace it, it is going to cost me 8,000. We will value the vehicle at 8,000 at replacement cost. And sometimes it's not the same vehicle we want to replace it. New vehicles are coming into the market. We want to replace with a more modern one, more newer one, technologically advanced one. So at that time, you will look at the vehicle, okay, my vehicle is 8,000, but if I'm going to replace this today, I'm going to use another bigger one, and that's going to be 12,000. So replacement cost of a more modern one. So that's another valuation method we can use. And the fair value. The fair value, that is the market value. In the present situation, if I want to sell this vehicle, what price can I sell it? So sometimes we call it net realizable value. And that's generally the market value. At what price can I sell on a reasonable situation, reasonable terms, what price can I sell? Then, then we look at something called economic value. So, the economic value is okay, we have used, it applies mostly for the property, plant, and equipment, mostly for the plant. We have already used the plant for 2 years. We see, we bought it for $15,000, used it for 2 years, and after 2 years, our depreciated cost is, let's assume it is 10,000. We find this machine can be used for next 10 years, and it is going to generate as a profit of 25,000. So the economic value of the asset will be 25,000. Even though we bought it for 15,000, now it has another 10 years of life period, and it will generate 25,000. Of course, it can happen the other way about. We bought a machine for 15,000. We thought it will go for 4 years, but after 2 years, new technology has come, new advancements have come, and no more value. So then the economic value will be zero because it's obsolete. You can't use it anymore. So that's what we call economic value. And finally, we do this one, but not too many things, but still, yeah, I think there was a question last week on this one, value in use. So we try to look at, okay, with this asset what we have, what can I earn in the next few years? Year 1, I can earn 100,000. Year 2, I can earn 200,000. Year 3, I can earn 50,000. Year 4, I can earn 40,000. So I'm looking for the future values, the future use of the vehicle, of the particular machine. And then I try to bring that all to the present value, discounting, taking interest rates. We will do that one, but that's not something in your syllabus, present value discounting. But he might give you these valuation models. Original cost, second hand value, replacement cost of a more modern machine, fair value, economic value, value in use. Value in use is to look at the future, and you can use this asset, you can generate revenue. But we know as the time goes off, time value of the money drops, we bring all that to the present value and we say it is 150,000. What we call value in use. This mostly you will use it in your later exams when we are doing the big ones, the strategic exams. You will use this one. But for the moment, you need to know there's something called value in use. Right? Yeah. So the next one, what we are going to look at is capital maintenance. Now, with the money that the company has got, what are we going to do? The company gets money from whom? The company gets money from the shareholders or the owners in the business. Let me put it in a different way. The business gets money from the owners, and that's what we call capital. And also we get money from the lenders. So the business gets money from owners, business get money from the lenders. All these monies are invested in what we call non-current assets. They are the property, plant, and equipment. And also we invest some money in what we call current assets. Current assets are inventory, trade receivables, and also the cash. So this is how we invest our money in a company. And this is what we call the total assets. Total assets are non-current assets. That is essentially the property, plant, and equipment, and current assets. Non-current assets are meant to be there for long periods. It's not to be used today and disposed of tomorrow. It will be there at least for more than 1 year. But the current assets, the inventory, your receivables, that is what you have to get from your customers to whom you have sold on credit, and your cash will always move, will float around. Property, plant, and equipment will be there for long periods of time. And all those money will be tied up in the property, plant, and equipment. So you have a duty as the owners or the managers to maintain this. If you take a vehicle, you have to service the vehicle. If you have a building, you must maintain the building. So the capital maintenance is to do with that one. So basically, there are two concepts of capital maintenance. One is what we call the financial concept of capital. That is, we must maintain the owner's capital. The owner originally invested 100,000. And maybe during the year, the company made a profit of 30,000. So the owner's new capital is 130,000. So the managers who are managing the organization, even if the owner is managing, he must ensure that he maintain it at 130 or increase it. If he makes losses, what happens? From 100,000, if he makes a loss of 20,000, it will come down to 80,000. That is a good capital maintenance. Capital maintenance is always you try to increase your capital base through profits. So you must ensure that a business is running at a profit all the time. That is what we call the financial concept of the next one is what we call the physical concept of capital. Whatever your assets, that must be properly maintained. If you don't maintain your machines, you can't produce the same number of units what you need to produce. You have to maintain, you have to service the machine, you have to care for the machine, you have to care for the vehicle, you have to care for the building. So there are two concepts of capital maintenance. One, what we call the financial concept of capital, and the other one, what we call the physical concept of capital. Both are very important, and both should be done simultaneously. So, what we realized was in the initial thing what we learned today, because the subject that we started today was all about the quantity, the preparation of financial statements. And it was all about the statements of the financials and the basis of preparation of financial statements, guidelines. They were the things what we call the accounting concepts and principles. before I move into the next subject, any questions that you all have on what we learned just now? You can unmute your mic and ask any questions if you all have anything to find it out. Yeah, Fatima, any questions you have? Harsha? No questions? Can I move to the next subject? Will you move to the next subject? Yeah. Could you explain financial and physical concepts again? Okay, thank you. Yeah. Basically, when we talk about capital, yeah, we are going to look at that one. When we talk about capital, we are talking in two ways of the capital. One way, we are looking at the capital from the owner's point of view. The capital is invested by the owner. In the company, it is the shareholders. In a company, the capital is invested by the owner. So, the owner puts 100,000 today and start a business. 1 year, the business has made a profit of 30,000. This 30,000 belongs to the owner. So his capital has increased from 100 to 30, 130,000, which is good. Right? Maybe next year, again another 20,000 profit. So he's happy. It has gone up to 150,000. But third year, it comes down by 10,000. Now, that is not very good because this 100 has now come down to 140. But let's assume next year he makes a 50,000 loss, the capital comes down to 90,000. So originally he invested 100, now it has dropped to 90. So that's not very good. So how to maintain the capital? Or in other words, how to maintain it at 100 or increase? To do that, only way what we have to do is we have to increase profit. Increase profit. With the profit, the capital will go up. But if you continue to make losses, the capital will erode, capital will come down, and the business will collapse. So it's a fundamental responsibility of the owners and the managers to maintain the capital. So this will be the main concern of the users of the financial statement to see the invested capital whether it is there or whether it is dropping. 1 year it can drop, but if it is continuously dropping, that's not good. So that's something the people will have to be very, very careful. Second one, the physical concept of capital. This capital, what we got, capital we can put it up in two different forms. One is capital that the owners have brought. The other one, when we talk about the capital, it is the capital. Yes, close. Questions we have, put it on the chat box. I will reply. I'm replying to Sharma's question now, the financial and physical concepts. So, the physical concept is basically the capital that you got from the owner is invested in the assets. Assets are property, plant, and equipment, mostly, and of course, the current assets. So, this property, plant, and equipment, we must maintain it. Imagine you buy a machine for 100,000. You don't properly maintain. Like with this 100,000 machine, you can produce 10,000 units, whatever the output. You don't maintain it, and finally, the machine collapses. So it is broken. So then you can produce 10,000 units. You can produce any units for that takes part. If you take a car, if you don't maintain the car, if you don't properly service the car, if you don't properly oil the car will stop running, isn't it? So because of that, we have to maintain. So we must have enough funds, enough resources kept to maintain the asset. That's what we call the physical concept of capital. So, I want to know whether the answer was okay for Sharma. Yes, Sharma? Yes, fine, thank you. Like that, anyone who has questions, please put it up on the chat box. I can say and I can answer any questions that can come. So, this is basically what we need to know about the preparation of the concepts, what is very important, because these are the guidelines we have. Whenever we are in business, we need to follow these guidelines. These guidelines are the light for us, the way that we are, the accountants are safe because we have the guidelines. If we don't have guidelines, we will have real problems. The people who are in the business world, they know that, if you don't have these guidelines, your directors, your owners will come and dictate terms to you. But because we have guidelines, we can tell we must put financial statements on accruals concept. We must put financial statements on going concern basis. We must maintain capital. We must prepare the statements on a relevancy basis. We must prepare the statements on materiality basis. We must prepare the statements on integrity without any misrepresentation. So we can say all that because we have these guidelines. So these are, in a way, these are some of safeguards we as accountants have in the business world. These are tools that are useful for us whenever we want to practice our things. So that's the first part of my subject area. I'm going to go into the next one. Let's see, as much as time permits, I will go into the next one. It is all about the presentation of financial statements. These slides also will be available. If anyone wants, just it will be available in Anju will put it in the Dropbox, and there will be a link. I think already it is there. But if you want anything personally, just send me an email. After this session, anyone who has questions, please send me any emails. I will reply to everyone, and I will say that whatever that is not clear will be cleared up to you. Okay, we are going to look at the presentation of financial statements. So as I said, we prepare financial statement. What is the purpose of financial statement? The purpose of financial statement is to provide the users of financial statements with the information about the financial position, about the financial performance, about the business cash flows, and also about the entity. Okay? So basically, when we prepare the financial statements, we give the financial position, we give the financial performance, we give the cash flows, what was our opening bank balance, and what was our closing balance. All that is given in the financial statement. So basically, the business is managed mostly not by the owners. Business is managed mostly by managers. Managers are managing. The owners will put the money. In a small business, the owner will put the money and run the business. But in big companies, the monies are put by the owners and shareholders, and the business is run by so-called managers, whom we call the directors. So basically, the directors or the managers have something called a stewardship responsibility. I'm the manager, I'm the director. It is your money that is given to me to run the company to make a profit for you. I have a responsibility. And that is what we call the stewardship. Every manager, every director has a responsibility, what is called stewardship. So the financial statement is the way that we tell our people the stewardship, how we show, how we have done. You all give me money, and after end of the year, if I tell that all of you all have given me 100,000, and if I tell you at the end of the year, sorry, I have run the company, but it's now 80,000. That's not good stewardship, right? That is, I have eroded your capital. I have not maintained your capital. I have reduced your capital. So that's the financial concept of capital maintenance is completely gone. You're supposed to be a good steward, at least you can't increase, at least I and maintain the figure. But always your purpose objective is to increase all the time. So how you provide that information for the people to know that whether you have done that job is done through the financial. Read the financial statements, they will know, oh, Kumar has done the job, or Kumar has not done the job. So that's what the financial statements will tell all the time. Right? So basically, the financial statements has simply few things what we look at. A couple of things what we're going to look at: assets, liability, income and expenditure, and these are what we call the elements of financial statements. So the financial statements will provide assets, liabilities, and equity. All these things are provided in what we call the statement of financial position. The statement of financial position provides all the information about assets, liabilities, and equity. Okay. Some person has asked prudence in short. Yeah. Prudence is basically you being very conservative. Conservative. That means you are not taking things very lightly. Yeah, as an accountant, we have to be very prudent. Prudent means we spend money very carefully. We don't take recognize unhatched eggs. We don't recognize unhatched chicken, right? So we are being very careful. So, say for example, I sell you goods. I sell goods to Mr. John, and Mr. John has to pay me 100,000 for the goods that he has sold. And uh, frankly speaking, I have sold the goods to Mr. John, so I can take credit for the 100,000 because I have sold the goods to John for 100,000, and John needs to pay me 100,000. But somehow I come to know that John is bankrupt. So because John is bankrupt, I'm not going to get money. So because of that, I will not take credit for that 100,000 revenue. I will provide it as a bad debt. Reason? I want to be prudent because I got some information. John is not doing well, right? Uh, Maybe that I have filed a case in court, and my lawyers tell me that I will get because some person has done me some damages. And lawyers tell me I'm going to get 25,000. I'm almost sure of getting 25,000 as a judgment. But I don't take credit for this one because I have not received it. The judge has not issued the order yet, and therefore I will not take credit. What is written below IAS 1? This is what we call the elements of financial statements. Elements of financial statements. Right? So the prudence, that is what I call the prudence. You have to be very conservative. Don't recognize any unrecognized income and allow all the expenditure, whatever you think you have to incur, provide. So on the expenditure side, we go to the extreme end of providing for every expenditure what we think will have to incur. But on the income side, we look at only what we think what we can get. So we are very prudent. We are very realistic. We are very conservative. So basically, we are talking now about the purpose of financial statements. So whenever we talk about financial statements, there are five elements. This is another question I think is one of the so set for the objective this question. The five elements of financial assets, liabilities, equity, income, expenses. assets, liabilities, equity, income, and expenses. Normally, assets minus liability is what we call equity in a company, or in a business. In a normal business, we call it capital. Assets minus liability. Assets are all what you have invested in the company. Liabilities are all what you have to pay to the others. The difference between that two is your owner's money, or what we call equity. Equity is another name for owner's capital. And in a business, in a sole trader business, normally we talk about limited companies. When you talk about a sole trader, is the capital. Assets minus liability is the capital. These three figures generally appear on the statement of financial position. So we will just minute we will go into the number of financial statements. These are appearing in what we call the statement of financial position. Earlier, our time we called it balance sheet, but now the new name is statement of financial position. I want all of you all to remember these names very carefully. Your examiner is very, very focused on the name. If you say the financial position, she will mark wrong. You have to say statement of financial position. This income and expenditure is coming up in a statement called statement of profit or loss. Statement of profit or loss. So here again, a little bit of English. If you say profit or loss statement, she might put wrong. It must be statement of profit or loss. It should be statement of financial position. These are a few things which you can score a lot of marks when you know this right terminology, because we should know the right terminology to be used in the IAS 1. IAS 1 is the accounting standard, international accounting standard for the preparation of financial statements. So these are the 5 elements what we see, and then we have another statement what we prepare, what we call the other changes in equity. So that basically shows us from the owner's capital from beginning to the end. So the beginning owner's capital, let's assume it is 100,000, and we have made a profit of, let's assume, 50,000 profit. Let's assume we have paid dividend if it's a company 20,000. So this will explain from beginning owner's capital of 100 to the closing owner's capital of 130, how the things have changed. 100 plus 50 minus 20 is the change, and that will be accounted, reflected in the statement of changes in equity. So the moment statement of financial position, statement of profit or loss, then this is called statement of changes in equity. This is not too much in our FFA paper, but later on you will require. So for the moment, just have it that one. Then the final statement we are going to look at is the cash flow. That explains in a different way from opening bank balance to the closing bank balance. And this is called statement of cash flow. John? Any questions that you have, John? Yes? So, statement of cash flow. So, these are the statements that we prepare. So, purpose of financial statement is to show stewardship of management to all the people, to the owners and to the rest of the people who are going to read the financial statement. The preparation of financial statements in the case of a company, it is with the board of directors. The accountant will prepare the financial statements, but the responsibility is with the board of directors. So if you are working in a company and if you have board of directors and they may not have the financial knowledge to prepare financial statements, They may get a good CIMA qualified accountant to prepare the financial statements, but the responsibility is with the director. But in a sole proprietorship, in a small business, the preparation of financial statements, again, it can be done by accounts clerk or it can be done by an accountant. The responsibility again is with the owner. So the financial statements is a very, very key document, and you and I, as accountants, we will prepare these statements. But the responsibility lies with the board of directors. But as CIMA qualified accountants, we can't get away from the responsibility if we have done any misrepresentation, if we have misled the people, if we have done something wrong. Oh, we have to be very, we will be taken for task, and the examiner, our council can even take our membership if they think that we have done anything wrong deliberately. You remember in the CIMA, we have something called Code of Ethics. That's also something which I'm just thinking about it. The Code of Ethics, you have to fall in line with 5 main principles. CIMA examiner is very, very focused on this one, integrity. Whenever we do something, we must be very truthful, not even a half a lie. We must be very truthful. That is what we call integrity. Then we must be very objective. That means we must never be biased. Some person says you prepare the financial statements in this way, that way. Don't do it. You are supposed to follow the concepts. You are supposed to follow the guideline and do it. And that's what we call objective. You are supposed to be very confidential. Financial information in the company that we are working, we should not discuss even with our own mother, even with our own sister, with our own husband, with our own brother, wife. We should not discuss. The information is confidential. Whatever the information that is put to the public is all right, but inside information is confidential and we must maintain. Professional competence. As CIMA qualified accountants, we must be always professionally competent. That means at any time we must be updated with all what is happening around. We must never, never be outdated. So all what you learn today, right up to the strategy level, will be useful, and beyond that also, it will be useful. So you can never forget all what we learned today. Just for the exam sake, don't learn it. You must be professionally competent all the time and also updated. So even after finish up the CIMA exam, even when you become a member, you have to do what we call continuing professional development, because you need to get that competency all the time. Next one is what we call professional behavior. You have to behave in such a way in business, outside business, wherever you go, you have to behave in such a way that you don't bring disgrace to the CIMA Institute, CIMA membership. So, in and out of office, you must behave in such a way that you maintain the dignity of your qualification, dignity of your membership. If you miss any of these things, your membership can be cancelled off. So that's why we have to be very integrity and the objectivity are two very important things. Whenever we prepare financial statements, we must ensure that we don't mislead people, neither we omit the information that is required by the people. We are there to serve the people, and we must serve it rightly. So the components of financial statement, basically whenever we talk about financial statements, any organization, it has 5 main statements. 5 main statements. Number 1, statement of financial position. This gives you the financial position on a given day. So generally it is 31st asset, 31st December, asset 31st March, asset 30th September. Always it is asset. So this is also another very important thing. Don't say statement of financial position for the year ended. Wrong. State financial position is a picture of the company as at a particular day, as at today, as at 30. So we prepare financial statements for a particular period. At the end of the period, we give our assets, we give our liabilities. The asset minus liabilities is equity or the capital, and that is what is reflected in the statement of financial position. So always remember the statement of financial position is asset. Asset 31st March, asset 30th September, and so on and so forth. Next statement is what we call the statement of profit or loss and other comprehensive income. So actually, other comprehensive income is not too relevant for you all, but what we need to be worried is statement of profit or loss. That is for the period. It is for a particular period. It is for year ended 31st March 2016. It is for the year ended 31st December 2015. It is for the 6 months ended 31st March 2016. Always, this is for a particular period. And this statement shows for that period your profit or loss. That is why it is called profit or loss. During our time, it was called profit and loss. But that is not the right one. It is statement of profit or loss. Because you can't have a profit and a loss. You can either have a profit or a loss. So this statement is called profit or loss, and that is prepared for a period, and that is for the year ended kind of a thing. Then the third statement is statement of changes in equity. This is normally prepared for limited liability companies, explaining the capital of the owner from the beginning, or the capital of the shareholders from the beginning to the capital of the shareholders till the end. So the capital of the shareholders at the beginning will increase the profit and will reduce with the dividend. The company shareholders get what we call dividend. Right? So they get something called a dividend. So always what they get is something called a dividend. So when you make a company, you have your owner's capital, or what we call equity capital. It may be 500,000. During the year, you make a profit of, say, 100,000, and then you pay a dividend to the shareholders, say 50,000. So statement of changes equity will be 500 plus 100 minus 50, which will be 550,000. So this is generally prepared only for limited companies, and it explains the statement of changes in equity, and that is what it is. And the final statement, the final one before the final, is what we call the statement of cash flows. We will learn little about this one in one of our future lessons. It explains in a nicer way from the opening balance, that is last year cash balance, the closing cash balance, what and what we did. How much did we earn as a profit? How much did we settle for liabilities? How much did we pay for assets? How much money did we pay for the owner? All these things will be explained from opening cash to the closing cash position. This is what the statement of cash flows. This is also for the total year ended, for a particular period. Statement of changes in equity, and statement of cash and cash flows, and the statement of profit or loss are prepared for the year ended. It is prepared for a period. It can be year ended, or it can be 6 months, or it can be 3 months. But the statement of financial position is always on a given day, as at. So this is there's only one statement that we prepare as at. Other 3 statements always prepared for the year ended, for the period. One more, in addition to all these 4 statements, statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flows, you have to do some notes, and your accounting policies explaining, so the reader will understand what are the policies that you have applied and how you got your figure. So I will continue from this one. So I think we are meeting when we meet our next lesson, we will look at all that part of it. Before I conclude, if you have any questions, you can put it to me and I will answer. No questions? Okay, I think we have another session, I think, on Friday. So Friday, we will be looking at the balance part of the financial review, and also we will be looking the next set, which will be ledger accounts, trial balance, little bit of calculations. We will be looking on those things in our next setup. If you don't have any other questions, I will be winding up the session. If you have any questions, you can just put it to me. No questions? Yeah, and the next session will be Friday. Friday, your time 7:50. That is on the 20th. We will have the next session. If you all have any questions, again, I'm giving my email. Put up any questions to me, and I will answer any questions whatever you all have. I will try my best to give you answers. You can send it to me, and we will answer. If you are, the slides will be available in the Dropbox, but if you anyone need any slides, send me an email. I will send you the slides. Okay, then. Thank you very much. I will meet you on again on Friday. Thank you. Bye. Have a good day.